Good afternoon, everyone. This is Michael Kimmel, and I'm happy to welcome you to RPB's Fall 2019 installment of our quarterly webinar series. And although we don't really celebrate it, happy Halloween. We're thrilled to have over 120 participants registered for today's call. In addition to myself and Len Teitelmelb, Chair of the Board, joining us today are David Baskin, Chair of our Investment Committee and President and Founder of Baskin Wealth Management, and Ross Bremen, partner with NEPC, RPB's outside investment consultant. Now, before I turn it over to Len, who will review the agenda and provide some opening remarks, a few housekeeping items. As always, this webinar is being recorded and will be posted to our website in a few days. We will also email a link to you. Regarding questions, thanks to those who submitted them in advance. In addition, we'll be able to address any questions you submit by simply clicking on the Q&A button found at the bottom of your screen. You could do this at any time, and we've set aside time at the end of the webinar to address them. Now I'll turn it over to Len.
Thank you, Michael, and good afternoon. I hope you'll find this webinar instructional in many respects. Our goal today is to give you more and better information about your investments so you can make more informed decisions and assist you with the basic question that's been posed in our last webinar. Do your investments meet your goals and your risk tolerance? As Michael said, based on your responses to our recent survey, and in addition, your calls to Robert Perry, the Director of Participant and Employee Services, it's become apparent that many participants in the RPB may not know exactly what they hold or are really invested in. And to repeat, do these investments meet your goals and your risk tolerance? Now, after our usual review of current market conditions and trends, as well as planned performance, we will have a thorough review of what is inside the portfolios of your Tier 1 fund choices. As Michael said, assisting in our discussion today will be David Baskin, founder and president of Baskin Financial, and a new face or name to you, Ross Bremen, who's a partner in our new outside investment advisory firm, NEPC. We're going to have Ross give you a brief description in a moment. I, Michael, and Stephanie Berger, our incredible Director of Marketing and Communications, will also join in the presentations where applicable. Now, one final comment, and then Ross from NEPC will give a quick glimpse into his firm. I'm pleased to tell you that Michael Kimmel was recently asked to become the vice chair of the Church Benefits Association, which is a nationally recognized group of all religious movements' benefit plans. This group, whose collective voice is exceedingly important, is a recognition that's well-deserved and should represent our Reformed Judaism philosophy at the highest level. Michael, good for you. Now, Michael's title has been changed to Chief Executive Officer for many reasons, but especially in light of his expanding role outside of your RPB. Enough introduction, Ross. Maybe you could introduce us to your firm, and then we'll proceed with our agenda.
Thanks, Len. As everyone heard, I'm Ross Bremen from NEPC. We're a large investment consulting firm in the United States. We work with 350 clients and we advise on over $1.1 trillion. We're about 288 employees in 8 offices across the United States. We're a partnership, so we're employee owned, and investment consulting is all we do. In terms of helping our clients, we help them in a variety of ways, including design of investment menus, assistance with asset allocation decisions, and then the selection of managers to fill different asset allocation buckets. We're going to be addressing these different areas as we move through the call today. With that brief introduction, let me turn it to David to talk about the markets.
And hi, everybody from wet and soggy Toronto. Happy to say that for almost all of our participants, it's been a very good first 3 quarters of the year. Equities have been strong, in fact, probably much stronger than anybody forecast. And even though the third quarter only showed a relatively modest return on the broad S&P 500 index, that followed 2 very strong quarters in the first half of the year, bringing the S&P 500 return to over 20%. Certainly something that almost nobody expected for 2019. It turns out that North America has been the place to be this year. The dynamics of interest rates around the world, which have seen negative interest rates in almost all of developed Europe as well as Japan, has sent a lot of money towards the United States. That's made the US dollar very strong. And as a result, returns on European stocks, that's the red arrow pointing downwards, have been modestly negative, and returns in the emerging markets continue to be quite disappointing. Another surprise has been just how strong bonds have been during 2019. As interest rates fall around the world, and we saw interest rates in the United States fall again yesterday as the Federal Reserve Board cut interest rates by 1/4 point, those invested particularly in the long end of the bond market have had terrific returns, not only in the past quarter, but also year to date. However, we can't let these good returns disguise the fact that there's lots of things to be concerned about, and that's probably why the Federal Reserve lowered interest rates yesterday, something that they would not normally do if there were no concerns. Among those, of course, are ongoing trade concerns, not only between the United States and China, but also between the United States and developed Europe, and the still unsigned North American Free Trade Agreement. There's a lot of nervousness going on. We've seen weakness in manufacturing in Midwestern American markets. The Chicago Purchasing Managers Index came in with quite a disappointing number. But in spite of that, we also see some strong indicators, including good housing start numbers and housing purchase numbers, and continued good employment numbers. So as I think Ross said at the last meeting of the investment committee, if you're not confused, you're not paying attention. It's a very mixed market with a lot of indicators going lots of directions. Stephanie, could we change the slide, please? Here you can see something that's very important, which is the level of interest rates set by central banks around the world. You can see that the Federal Reserve is, even after lowering by 1/4 point yesterday, still an outlier with a target interest rate of 1.5 to 1.75%. European Central Bank at 0, Bank of Japan at a negative number. Again, something that most economists never thought that we would see, something very difficult to explain. There's over $17 trillion worth of bonds trading around the world with negative returns. An anomalous situation which many people think can't last forever. But in spite of that, as the next slide will show you, market participants are having a very strong 2019, and it's very difficult to find an asset category that hasn't made at least some money. The longest blue line on this graph, as I said a few minutes ago, those who chose to buy the longest bonds have been rewarded the most, over 27% on so-called stripped bonds. Those are ones with maximum duration. But the S&P 500 at over 20% is certainly gratifying, as is the broader Russell 2500 at 17%. As I said, staying in North America was a better strategy than investing around the world this year. But as you can see, for year to date, everybody's making at least some money somewhere, and this in turn is reflected in the quilt that we like to show you when we have these calls. The quilt shows the return on various asset classes over time. And on this one, the year to date is the furthest right column, the one with the gray number at the top, which indicates that real estate has done very well. But right below that are American large cap stocks, followed by Europe and so forth. The point of the quilt is not who's doing best this year or this quarter. The point is to show you the reason why wise investors diversify. The asset which might be doing the best this year might easily have done the worst in a prior year, and that which was last might easily be first. It's our job as managers and as fiduciaries for your money to ensure that you have a broad exposure to a number of asset classes, so that should we have an asset class that does very badly indeed, it won't kill you. But nonetheless, we want to have enough exposure to the good ones that when they go up, we do pretty well. There's no question, I think, in anybody's mind that we're in the late stages of the business cycle. This is, by some measures, the longest continuous expansion of the US economy in history. The economy started to expand in the second quarter of 2009, more than 10 years ago. By anybody's measure, we're getting late in the cycle. And what we see late in the cycle generally is profitable companies, but moderating growth, profit margins starting to moderate, and perhaps inflation rising. What makes this expansion confusing is that, in fact, interest rates are falling rather than rising. Inflation is very modest, very stable. Unemployment continues to fall, but nonetheless, we haven't seen any upward pressure on wages, or at least not significant upward pressure on wages. That's why it's a very confusing situation. I will say that we're now about 3/4 of the way through earnings season for the big companies in the United States. And by the measure I saw this morning, something like 3/4 of the companies that have reported so far have exceeded analysts' expectations for their earnings. So even though we are late in the cycle, profits continue to be quite healthy, and that supports a pretty strong stock market. It's the case that the stock market always, in the end, will look to the earnings of the companies. And as long as those earnings are strong, there's no reason to think the stock market is in for a bad period. Stephanie, can we go to the last slide in this segment? So here's the most important point. Although we know that recessions happen sooner or later, just because we're late in the cycle doesn't mean we're at the end of the cycle. If we continue to see positive economic data, for example, in housing and in consumer spending, there's no reason to think that the economic expansion, no matter how long it is, can't continue further. Nonetheless, prudent investment managers recognize that it's wise to have a balanced portfolio, that we shouldn't let the gains that we've made year to date fool us into thinking that we're going to make 20% every year. Because there's a lot of nervous people around, it's probably expected that volatility will increase in the fourth quarter. Things like the US-China trade policy that are very much up in the air and subject to headlines, it seems, on a daily basis, or if not hourly. Actual changes in earnings and interest rates can certainly make the markets more volatile. Our Tier 1 funds, which are managed funds on behalf of our participants, they're multi-manager funds that have assets allocated on a number of different professionally managed platforms, are designed to be more protective in down markets. In other words, there's a priority put on capital protection, sometimes at the expense of full participation in an up market. And your investment committee has taken a lot of attention to make sure that we're well positioned for a late cycle market. So that being said about the economy, I want to talk a little bit about how our funds have actually done in the first 3 quarters of the year. The Capital Appreciation Fund, which is the product that, as the name suggests, is directed towards making capital gains and participating in the earnings of corporations, is having a very good year so far, 16.3% compared to 15.9% for a broad world index of equities. That's a pretty good outperformance. Similarly, the Appreciation and Income Fund, which is just an amalgamation of the Capital Appreciation Fund and the Income Focus Fund, is also showing what, for a fund such as that, is really quite a stellar return of 13%. And finally, the Income Focus Fund itself, which is primarily a fixed income fund, is showing a return of 8.9%. You may well want to ask the question, how is it that if interest rates are very low and falling, if corporate bonds in the United States are paying 2% and government bonds are paying 1%, how do you make 8.9% in the bond market in 3 quarters? Well, the answer to that is that bond prices move inversely to bond yields. And when bond yields continue to fall as they have, the prices of the bonds we own go up in value. That's what allows us to make returns such as that. And I should also say that the Income Focused Fund is not 100% fixed income. It also has some enhancing products that allow us to earn better returns when the times are right. Finally, our Capital Preservation Fund, our rock solid, can't lose money under any circumstances product, is showing a very modest return of 1.7%. I think that just about beats inflation for the first 3 quarters of the year. But as expected, while it's not making anybody poor, it's not making anybody rich either. Could we show, please, the next slide, Stephanie? The way that we measure the riskiness of our products is by the standard deviation, how volatile these products are compared to the market itself. If we're less volatile than the market, then we're taking less risk. And as you can see, our capital appreciation product is in fact less volatile than the total market, actually considerably less volatile. And the fact that we've earned a return better than the market while taking less risk is a testament both to good asset allocation and good performance by our managers. The Appreciation and Income Fund, the standard deviation, the riskiness is just exactly on the market, while our Income Focused Fund is a little less risky than the overall market, in spite of having pretty good returns. So I think it's fair to say that our Tier 1 managers have had a very good first 3 quarters of the year, and participants in Tier 1, as a result, I think, have enjoyed a very good return with less than market risk. Finally, I want to talk about our Tier 2 products. These are our do-it-yourself products, which participants get to select for themselves. And most of these products are index products, which should track their benchmarks very closely indeed. And as you can see by looking at the lines, that's the case, except for the product on the very far right of your screen, the Jewish Values Investment Product, which is showing a return of 18.4% compared to 16.2% for its benchmark. We're trying to understand why the Jewish Values Investment Fund should have such stellar returns, perhaps blessings from on high, or it might have something to do with the fact that technology companies are overweighted in the fund because they have a light carbon footprint, or it could be because, in fact, we don't have a lot of oil and gas products in the fund because of their climate impact, and oil and gas has been a bad asset to hold. So there you have it. That's the performance of the Tier 1, the managed products, and the Tier 2 for the first 9 months of the year. I want to say a little bit before I turn this over to Ross about the way that these funds have been designed. prior to 2012, we named these funds after the products that they own. So we had an equities fund and a bond fund and a 60/40 fund. Starting around 7 years ago, we said, well, why don't we name these funds after what they're supposed to do? What's their objective? The objective of the Capital Appreciation Fund is just that, to have capital appreciation. The objective of the Income Fund is just that, to generate income. I can tell you that naming the funds after their objective focuses the investment committee on how those funds are supposed to behave and just what they're supposed to do. Starting in 2016, we added some passive products. We recognized that the chance of managers to add value in certain markets was very limited and that it wasn't a good idea to pay them a lot. So we replaced them with passive index funds to some extent. The Reformed Jewish Values Fund, which had a gestation period, I think, of 5 to 7 years, was added in 2017. We have, I think, about 1% of all of the assets of the RPB now invested in the JVI, and I hope participants will put more money in. And finally, overall, 88% of RPB assets remain in the managed products, the Tier 1 funds. People have had the chance to be in the Tier 2 funds for a few years now, and about 12% of all the money has migrated to the do-it-yourself Tier 2 funds. So I'm now going to turn it over to Ross, and he's going to talk about what's under the hood, about how we're doing what we're doing in the Tier 1 funds.
Thanks, David. Stephanie, if you can turn to the next slide, please. And one more. So as I mentioned earlier, at NEPC, we help our clients with asset allocation, manager selection, and your Tier 1 portfolios are designed for the do-it-yourself, the do-it-for-me participants, the participants that feel more comfortable, I'll do it myself. They'll use the Tier 2 funds where they can pick and choose the different investments that they want to use. But for those participants that are less comfortable, that want more of the turnkey solution, they're going to use the Tier 1 funds. And so how are those Tier 1 funds built? It starts with asset allocation. When we work with the committee, we take a look at the name of the fund, say Capital Appreciation or Income Focused, and we try to match the portfolio up with the risk return profile of that portfolio. So for example, with the Capital Appreciation portfolio, that's designed for growth. And so given that growth objective, we know that we're probably going to own more stocks in that portfolio. If it's income focused, that's going to be more income oriented. And so as a result, it's likely to have more bonds. So the asset allocation decision, it starts with matching up the objective with the mix of stocks and bonds. And we might also mix in some other asset classes like real estate or commodities if we can get diversification benefit and enhance the risk return profile. Once we have a general idea of what the asset allocation should look like, there are then other investment decisions to be made. If we decide that we want to own a lot of stocks, we have to decide, do we want to own or pick managers that invest in big companies or small companies? Do we want managers that invest in US companies or non-US companies? And then lastly, do we want to invest in managers that are actively managed, or do we want passive investments? And I'll come back to that active-passive conversation in just a few minutes. Once we've identified the buckets through the asset allocation process and then these other investment considerations, we then have to fill those buckets. And that's the manager selection. We go to the marketplace and we work with the committee to identify managers to fill each of the buckets that have been identified through the earlier pieces of the process. Next slide, please. When we focus on the manager selection, often the manager selection gets a lot of attention as part of the process. We really start with the full, broad universe of managers that are out there. If you look at public databases, there are thousands and thousands of managers that are available in the marketplace today. And then we use quantitative screening to really narrow down the universe based on criteria such as reasonable fees, reasonable performance, managers that have been in place for some period of time. And so after we've taken the full universe of thousands of managers and narrow it down to a more reasonable set that we can work with, we then meet with the managers to figure out which ones we like from a qualitative perspective. Does the manager have a clear thesis? Does he or she have a repeatable process that is going to lead to outperformance over time? To the extent that we identify some managers that we think we like, here at NEPC, we have a very tenured due diligence committee of about 15 senior folks who then take a look at this narrow group of managers that we've identified as potentially top tier managers, and they formalize the lists, the recommended lists, if you will. And those are the managers that we then discuss with the investment committee and the broader RPB board to see which ones make the most sense for the asset allocation buckets that we've come up with. And then, of course, on an ongoing basis, we meet with the investment committee and the board to take a look and see if we've chosen well, if we've made mistakes. As fiduciaries, the board is regularly revisiting the investment program as it exists and thinking about whether there are changes that should be considered. Next slide, please. If we look at the program, the Tier 1 funds, and the fact sheets are available on the website and other forms of communication, you can see that you have many different asset classes represented. You can see that you have US stocks, you have international stocks, emerging market stocks, US bonds, real assets, including real estate and some energy partnerships. And so you have a lot of diversification. Again, these portfolios are built for the do-it-for-me investors as opposed to the do-it-yourself investors that might be more likely to, again, invest in the Tier 2 funds. So these portfolios include a lot of asset classes, multiple managers. You can see that if you look on the right-hand side of this page, you can see that there are several Vanguard funds in the portfolios. You can see Pinnacle as a manager, Artisan as a manager, Wellington as a manager. So you have diversification across asset classes, diversification across managers, and then you also have diversification across styles. And what do I mean by that? You often have styles that might be identified as growth and value, for example. And just because a portfolio might have a value tilt, it doesn't mean that it's not trying to achieve growth. It just means that it's looking at different characteristics of companies and viewing them, in a different light than folks that might focus on a growth manager, for example. And so just real quickly, what do I mean as it relates to growth versus value? Growth oriented, you might think of technology stocks that have very consistent high levels of growth. There's not always confidence that those high levels of growth will continue, and so there can be volatility, but the growth style focuses on attempting to identify the highest levels of consistent growth over time. A value orientation focuses more on intrinsic value, and you're really trying to identify growing companies that are attractively priced. And so that's where the value name comes from. And over long periods of time, the value orientation tends to be a little bit less volatile than the growth orientation. And so as a result, the RPB and the board have chosen to pursue pre-mixed portfolios that have a little bit more of a value orientation, that have a little bit more of a focus on risk minimization or mitigation while still achieving strong returns. And you saw that when David showed the charts just a few seconds ago that showed high returns year to date. And then the next slide showed that standard deviation, the measure of risk, has been slightly lower than the benchmarks over time. We also, with these portfolios, see a combination of active and passive management. Stephanie, if you can turn to the next slide, please. What is active versus passive management? Passive management, the manager is attempting to replicate a benchmark. That manager is owning everything that's in the benchmark, the good, the bad, the ugly. And so regardless of what the market does, the passive manager is going to be moving up or down in lockstep with that particular index. Active managers seek to enhance the index from either a return perspective and or a risk reduction perspective. And so an active manager is going to try to improve upon the benchmark from a return perspective or from a risk reduction perspective. And the way that he or she does that is by not owning everything, potentially overweighting some companies that he or she may like, investing outside of the benchmark to enhance the portfolio that way. And so to the extent that there are these different approaches, the Tier 1 portfolios today include elements of both active and passive management. Next slide, please. One other thing that is also very important to RPB, and David mentioned a few seconds ago, the Jewish Values Fund. The RPB portfolios, the Tier 1 funds, are investing in Jewish values portfolios to the extent that they can. And what I mean by that is some of the managers that are part of the Tier 1 funds have the ability to exclude certain types of securities, and those types of securities, you can see them on this page. You can see that managers in some cases can exclude tobacco companies, companies operating in Sudan, those that have predatory lending practices, firearms, landmines, coal and consumable fuels. Those types of companies and organizations can be screened out by these managers. These managers might also have the ability to invest in community development bonds, and so that's a positive. And so they can overweight different types of securities that Jewish Values recognizes as being more beneficial. And so I think it's important that to the extent that the committee is operating in a fiduciary fashion, it is trying to, from a mission perspective, not only do things that are viewed as favorable and appropriate from the broader Jewish community perspective, but also to the extent that a lot of these practices of these companies that are being excluded, that they may potentially be limiting on the performance of those companies, to the extent that companies that operate in a more socially responsible fashion, that they might perform better over time. The hope is that the Jewish values mesh with better risk return profiles over time. And the hope is that Jewish values will actually lead to better outcomes for participants over time. Next slide, please. And so, as we've said, there's a lot of diversification in these portfolios. We've talked about the asset mix from a manager perspective and an asset allocation perspective. We haven't talked, we can drill down even further. We haven't talked about sectors or specific stocks. Stephanie, if you can actually build out these charts in their entirety. So as you look across the different portfolios, you can see that the Capital Appreciation Fund has several different asset classes. The different colors represent the different asset classes consistent with the quilt chart that you saw earlier. And you can see the Capital Appreciation Fund has the orange and the yellow. And so that shows that it has a lot of exposure to stocks, but you can see there's also diversification there to the extent that the orange colored box is US stocks and the yellow is non-US. You also have emerging market stocks there, some green, and US bonds, the blue. As you move to the income focused fund, you see diversification from capital appreciation. You can see diversification from the income focused as well, although there you have the blue, which is a big slug of bonds, and much less in terms of other asset classes, a small orange component, but a bigger kind of gray exposure to the extent that you have some other diversification in there beyond just bonds. Importantly, the Appreciation and Income Fund is a mix of income focused and capital appreciation. So you see the mix of stocks and bonds there, the mix of the colors from both capital appreciation and income focused. So you achieve even greater diversification in the Appreciation and Income Fund than you do with the Capital Appreciation Fund, which is more growth oriented, and the Income Focused Fund, which is more income focused. Next slide, please. And I said you could drill down to sectors. So here we show the different sectors that are made up in the different portfolios. You can see that capital appreciation, income focused, that they all own sort of the full range of equity sectors, materials, consumer staples, utilities, but they own different amounts. And so you're getting exposure to all the sectors, but you have diversification of sectors, and you, depending on the product, you're owning different amounts of the sectors.
Ross?
Next slide, please.
Ross, let me jump in. This is Michael for just one moment. Could
Sure.
you talk for just a minute about sort of the sector allocation versus the asset class allocation and the decisions and the thoughts that go into what the committee decides, right? Because our focus, for example, is about asset class allocation, which is from the previous slide. The result being we land on a certain equity sector allocation, correct?
Yep, yep. And so I think that the way that we're working with the committee is that we're coming up with the broad asset class allocations. We're then deciding where we want the exposures to be, whether domestic, non-US, whether we want active, passive. As we then keep moving down into the sector allocations, we're thinking, okay, to the extent that we want the capital appreciation to have growth characteristics, which economic sectors are going to be generating the growth. To the extent that the income focused fund is more focused on income, and to the extent that it is also designed to be less risky than the the Capital Appreciation Fund, which economic sectors are going to be less volatile, on a go-forward basis. And so we're constantly looking at the economic sectors. We're constantly looking at the managers. We're seeing where the exposures are. I actually think that the example that David gave just a second ago of the Jewish Values Fund, where you see perhaps higher exposure to technology, which has been additive, and lower exposure to energy, which has been additive. Those are the types of things that we're thinking about as it relates to the sectors. And at the end of the day, you can see that there's broad exposure to the different sectors, but you're going to own different amounts depending on the portfolios. And the same is true as it relates to fixed income. And so as you look at the income focused fund, you can see that the income focused fund has some high yield bonds. It has non-US credit. It has investment grade. So you have broad fixed income exposure. You also have some exposure to fixed income in the Capital Appreciation Fund, but you can see that it's primarily in high yield bonds, which tend to operate a little bit more like stocks over time. So again, you have broad sector diversification. It's a little bit easier to see, to maybe Michael's question, it's a little bit easier to see that in this case, we wanted to overweight high yield bonds and capital appreciation in order to take advantage of the growth characteristics of high yield as opposed to the other bond sectors, which are less aggressive from a growth perspective. And then we can drill down even further. Obviously, you have the specific companies that are held by each of the managers, and you can see that there's a lot of commonality across the different portfolios, but the amount that the managers invest in each of the stocks is different. And again, I think if you step back and you think about it from a high level, again, you have diversification across asset classes, you have diversification across managers, you have diversification across styles, you have diversification across economic sectors, and here you have diversification across individual names in the portfolios. And so again, these tier one portfolios, the do-it-for-me portfolios really try to build these well-diversified portfolios to meet those objectives, which have been specified, again, growth, income, or a mix of growth and income. And with that, I'm going to turn it to Michael to take it from here.
Thank you, Ross. So now that we have a better sense around the tier one funds, how they're constructed, what they're comprised of, we just wanted to spend just a couple of minutes and talk about these funds and your investment strategy. As we've long said, the things that one needs to consider when investing is how much risk are you willing to take? What's your tolerance for risk? How much can you stomach? Can you sleep at night with, for example, something that's more aggressive than the average? Or would you be better off sleeping well, but knowing that you may be giving up potential return because it's invested a little bit more conservatively? Of course, you have to think about your time horizon and how long do you have? And we're going to talk a little bit more. Our next slide actually gets into a little bit about time horizon. And then with tier one and the funds in your investment strategy, how do those align or coordinate with your other assets, whether it be spousal or partner retirement assets, whether it be your taxable accounts? You may have investments with Merrill Lynch or E-Trade or whomever. And so those are all things you need to consider when thinking about not only your tier one funds, but your overarching investment strategy. And you could see from the chart here that where the various funds align relative to risk and potential reward with the Capital Preservation Fund being on the bottom left, being the least risky and the least volatile, all the way up to the Capital Appreciation Fund, which has the most opportunity for return, but also has the highest level of potential volatility. Now, in terms of where you are and your time horizon, again, this is very generalized, but generally speaking, you're younger, you're earlier in your career, you're just starting out. People tend to be, or typically are invested in more for growth, which generally means you're invested more in growth-oriented investments. And for Tier 1, that means the Capital Appreciation Fund. As you move along in your career and you get a little bit older, again, not knowing anything else about you, you may be starting to shift your focus, and you may want to start moving some of your money from the Capital Appreciation Fund into the Income Focused Fund, or divest just in the middle fund, which is our Appreciation and Income Fund. Then, of course, as you get closer to retirement and your goal is about, or your objective is about income and preserving spending power, maybe you want to be yet a little bit more conservative with your investments. By the way, that doesn't mean you should be only in bonds. And David, and we could all talk at length about the importance of potentially having some money in the equity markets, even into retirement, to make sure you have the opportunity for your retirement to last throughout your life. Now, it's very important to keep in mind that when you're thinking about the Tier 1 funds and how they work. Now, you've heard already a number of times that the Appreciation and Income Fund is simply a mix of the Capital Appreciation Fund and the Income Focused Fund. Right now, it's actually 55% of one and 45% of the other. If you believe that that's the right investment mix for you, put 100% of your portfolio into that one fund. If, however, you believe that you would desire something other than 55-45, our suggestion would be you take it all out of that one fund and you put whatever allocation you want into the two funds, the Capital Appreciation Fund and the Income Focused Fund. So, for example, let's say you're a little bit younger and you feel like you want to have an 80-20 mix, right? 80 growth, 20 income. Put 80% in Capital Appreciation and 20% in the Income Focused Fund. What we're actually seeing is a lot of people are invested in all three funds, and in some cases, all four of our Tier 1 funds. While that's fine, it just makes it a little bit more difficult to look at your portfolio and understand how you're strategically allocated based on your objectives. So this is just a slide we wanted to share with you for you to think about as you look at your own portfolio.
Michael, excuse me, Leonard, Tom, if I could just add one thing. This is a very critical point. It makes no sense to me, or as an individual, why you go across all four funds. And one of the objectives here was what's in those funds. Do I have the right amount of equities for me, balanced off with the right amount of income oriented? So please take a look at how you're allocated and know how much you have, like our earlier slide showed, how much I have total investment in equities, total investment in non-equity portions. That's what this is about. And we ask you to carefully take a look at this to make sure it meets your goals.
Thank you, Len. Now, of course, you can also invest in Tier 2. I mean, our system is designed to allow you to invest in, quite frankly, all 14 of our funds if you so desire. We don't necessarily suggest that, but you certainly have the ability to do that. Tier 1 funds, as we've talked about, already diversified across asset classes, and you get access to active management. Now, we talked about the do-it-yourselfers versus the do-it-for-me's, and typically the Tier 1 funds are the do-it-for-me's, although many of you, I believe, probably believe in active management and like the approach of Tier 1, and so therefore you left your money there. I, for one, believe in that, even though I know a little bit about how to allocate on my own. And Tier 2 is for you, obviously, to create your own portfolio, knowing that each of those index funds is invested in only one asset class. It is passive only. And of course, the RJV fund is also in there in our Tier 2 fund for socially responsible investing. And we also say that Tier 2 funds are there if you really want to be able to try to strategically align your RPB funds with non-RPB funds. so maybe a little bit easier to do that. So we have a full cadre of investment options for you, and we're always looking for new investment ideas, and certainly if those come to light, we will share them with you. So with that, that's the end of our presentation, and now we will turn to some Q&A. And so there you go. So some Q&A.
All right. We have a first question here that we have is, does the RPB plan to add an investment vehicle that gives plan participants greater exposure to the energy sector? David, and why don't you take a look at that one as head of our investment committee?
Yeah, the answer is it's not really something that's on our horizon right now. We don't think that the prospects for that sector are particularly bright. And I should also note that there's now exchange traded funds for virtually any sector that you can think about. But that being said, one of the things that we entrust to NEPC is to bring to the investment committee new ideas all the time. And if, for example, there was a product that they felt we should add in order to get further diversification and possibly better returns, then obviously we'd consider it.
Ross, I want you to try and answer this one, if you would, please. To what extent, if any, do our pension fund managers use artificial intelligence in their work?
Sure. So I think it's fair to say that that technology is very prevalent in the investment management world today, and investment managers are using technology more and more as part of their processes. The portfolios today do not rely on sort of black box decision making to drive the portfolios today. So again, I think technology more and more prevalent, but not driving the decisions, at least not yet anyway.
David, I want you to try this one. What would a balanced portfolio for a retired rabbi look like for an upcoming recession, and when would you switch to it? And the answer is the day before the recession hits is not a valid answer.
Well, one is reminded of the story of the rabbi is asked by a disciple, when should you repent? And the rabbi says you should repent the day before you die. So the answer, I think, is this. Nobody knows how to time markets. Even for retired participants in the plan, unless they feel that their time horizon is very limited, by which I would say less than 3 years, an attempt to guess when a recession is coming, switch the asset allocation to a more conservative allocation, and then know exactly when to go back to a more aggressive asset allocation is almost certainly doomed to failure. What we learned in the 2008 to 2009 recession, which was the deepest, most brutal recession in 70 years, is that good quality assets dipped in value, some for as long as a year, some even for 18 months or 2 years, but that the good quality assets came back. And we also learned that dividends are surprisingly robust, that many of the companies in our portfolio kept paying their dividends during the recession, some even increased them. So if you are a cautious retired participant, perhaps you should be in the Appreciation Plus Income Fund, which is currently allocated 55% equity, 45% fixed income, which was an adjustment that the committee made a couple quarters ago to become more conservative. I think that's a good place to be. And because we don't know when and if a recession is coming, I wouldn't attempt to time any changes.
Another question, do we risk overstating 2019 equity returns given the significant drop at the end of 2018? Ross and/or David, why don't you take that one? In other words, we're coming off the bottom, so we look better, I think is what they're trying to say. But well, I'll let you try and interpret.
The the length of time it takes the Earth to rotate around the sun is a fairly arbitrary period anyway. And, you know, if you went from October 1st to October 1st, the participant who asked that question is, of course, entirely right. It wouldn't be 20%. It would be a lower number than that. So, I mean, that's correct. But conventionally, we measure things by calendar years. It might be a little misleading because of the very, very weak fourth quarter of 2018, but I guess that's how we do things.
Ross, you have anything to add to that?
I think I would just add that ignoring what's happening today, the market has continued to reach new highs. And so, you know, I think that we just have to maintain the long-term perspective. There's going to be ups and downs over time. And that's why we put money in every pay period to the extent we can. And over the long term, the market goes up a lot more than it goes down.
I've been in the investment business since 1965, and I was taught early on that if you drive looking in the rearview mirror, you could hit something. I would suggest that the proper perspective is forward-looking, learning from the end, but to try and look forward, and I think that's where the focus should be. To what degree, another question for all of us, to what degree do we need to be concerned with the impeachment process on equities?
You know, Len,
you can escape that one if you want, because you got a new premier up there.
We got the same old prime minister.
Yeah.
Interestingly enough, I was looking at a blog today about what happened during the Nixon impeachment business, which was, I guess, 47 years ago. And it didn't have a big impact on the stock market. Nixon was, of course, also a Republican president, widely loathed by liberals. But his eventual resignation had really a very evanescent, a very fleeting impact on the stock market. I don't know if that would be the case this time. We're in a different environment with the social media and Fox News, and I really can't. I don't think anybody knows the answer.
I think that'll end. I'm going to ask one last question here, and I'm going to ask Michael to take care of it. The RPB Retirement Planning Seminar, this individual went there about 7 years ago, excuse me, and have there been some changes to the seminar since the last he attended 7 years ago? And he's much closer to retirement now, so the seminar may become even more valuable to me. Do you agree? Thank you for bringing that up.
Thank you, Len.
Then I'll close.
So the basic structure of the retirement seminar hasn't changed materially. There's still very similar topics. But what I would say to this individual, and to really anybody who has attended and is thinking of attending again, come. The feedback that we get from people who have attended more than once is dramatically positive. They say they come to it with a different mindset, in a different light. Their questions are different and have evolved. And so they find it, even though it's the same material, to be extremely valuable. And in fact, we've actually had some people come a third time because they find that they'll come 10 years from retirement, maybe 4 years from retirement, and maybe a year before retirement. And they're finding themselves with new questions, new things to think about, and have walked away with some really positive things to do. And actually, you could see on our screen here that our next retirement seminar is coming up around a year from now, almost a little more than a year from now, in Florida. The exact site to be determined. We're doing some site visits coming up later this fall, and we'll be picking a final city and hotel, and we'll let everyone know about that.
Because of the time, I would like to end this webinar with a thank you. First to Stephanie Berger, your Director of Marketing and Communications. Now, the work that goes into these webinars is tough and many-faceted. Michael Kimball, your Chief Executive Officer, has proven again that he has brought not only a new energy to the RPB, but also the ability to assemble an all-America team to provide the support needed to make the handling of your assets at the exceptional level you deserve. Finally, I'd like to thank you, I'd like to thank you to those especially on the call who responded to our recent participant survey. Your input is vital in helping us meet your needs. And this year's survey affirmed that the changes we have made over the last 3 years have not only helped you as individuals, but to better manage your retirement savings. It also gave us ideas for future improvements and for future webinar topics. Having been chair of the investment committee when this process was put in 2012 and now as chair of the board, I can tell you that the people who sit in this office to my right absolutely deserve not only your thanks, but I think a well done to everyone. It's been a hell of a job. So thank you for tuning. We will let you know about our next webinar coming up. We'd appreciate any comments that you make. Thank you very much, and have a good winter.